We have Charles Ortel of Newport Value Partners joining us from New York this morning. Charles, that is so true about markets right now. So it looks like a hope has been shattered with Angela Merkel's spokesperson saying we're not going to get this European debt crisis solved by next weekend, as it seemed that the market had priced in.
Absolutely. I mean, we have a very simple problem around the world, and that is the advanced nations, the Western nations, including Japan and Korea, decided to host a globalization party, but we really weren't prepared to pay the bill. And the bill is that our own workers, who in about 38 countries that we call the gray zone, the advanced, aging markets where there's slow population growth, in those countries, most workers, relative to world scale, are significantly overpaid and can thus be easily replaced by geographic switching, by robots, by engineering labor out of the equation. On top of which, since about 1999, most of these nations have been engaged in deficit financing and borrowing against assets. And now we've really got to get serious about getting our debt properly in line, not with GDP, which we think overstates the ability to service debt, but with true private sector income, income from industries that actually serve the global market. The United States, you haven't mentioned that ratio, but the United States ratio of debt to GDP doesn't look that bad. But when you look at debt to private sector income in the United States, it's off the charts high. And we are the guarantor for global security around the world. So actually our situation, I think, is even more dire than Europe's.
Even more dire than Europe. Well, it seems like we have a Europe catastrophe that seems imminent. I mean, as you saw with the sell-off that we saw in recent months. What kind of solution? I mean, are you expecting some sort of agreement next weekend at least, and what would you be disappointed with?
Well, I'm not expecting a solution next week at all. I mean, I called last February for Greece to default, and the reason is that, you know, if you look at certain countries in Europe, they cannot hope to compete in Europe and on the world stage with a population profile as small and as high a component of senior people and as much debt. So quite simply, the only way to get that intact inside some of these countries is to default, to get the debt down. As far as Europe is concerned, if they were to follow the examples set in the United States between after 1782 to 1789, when we had a confederation that didn't work, it might work. You could rationalize the cost of government. And that's the tough thing that Europe has to do. They're spending way too much on redistribution, on public sector bureaucrats that they can't afford.
Okay, but don't forget that Confederation in the U.S. went through in different ways as well. Some say fragmented. Are you saying that that's what's going to happen to Europe and the Eurozone? It's going to implode and break apart?
Well, you know, who actually knows, and I wish I did know for certain, but, you know, I've talked to many, many people over the recent months, and, you know, I try to put myself in the shoes of the various countries that stand to lose the most if they continue to subsidize this wasteful spending. And if I were sitting in Germany right now, what I would be thinking about is, you know, the experiment since 1999, we don't need a lot of more evidence to know that it isn't working the way we'd hoped. So why don't we consider ourselves as Germany, and I'm sure they'll howl and scream and say they'd never do this, but maybe they should leave the Eurozone, and maybe they should contemplate having a two-currency policy, a hard currency to protect the value of certain assets, and a soft currency that might be denominated around the former eastern piece of Germany.
All right. Well, Charles, thanks for sharing your thoughts today. Pretty insightful. Charles Ortel of Newport Value Partners joining us from New York.